$213 an ounce silver. I've been saying for a long time that triple-digit silver is in the cards. All it takes is some sort of crisis and for people to be rushing back to it as a safe haven. And we will be seeing triple-digit silver. I believe that this is an absolute. Hi, everyone. It's Mike and Alan again with the Gold Silver Show, and this show is mostly silver and closing the year 2024 and where things may be going in 2025. So, Alan, show us what you got.
Yeah, thanks, Mike. Well, I thought it would be great to do a 2025 outlook, basically looking at two main pieces. The first, of course, is supply and demand, right? Everything boils down to supply and demand. So we're going to look at the supply of silver and the demand of silver, but also keep in mind, everything is relative. So we can't just look at silver in isolation. We have to look at it relative to other assets. So those are the two pieces I want to look at today. And I thought as a nice springboard, we could take this article that was updated in November. And it does sound like it's outdated. It uses old data, but it is one of the newest pieces that we have. The silver market faces a third consecutive deficit in 2023. Yes, 2023, not 2024 or even 2025, despite a 7% price increase. So it does take a long time for us to get accurate mining data from around the world. But basically, 2023 was a third consecutive year of a deficit. 2024 was a fourth year, and 2025 will probably be a fifth year. So yeah. I thought it'd be useful to take a look at some.
Also, I want to comment that that 7% price increase. So that was back in 2023. The 2024 had a pretty spectacular price increase, actually. Gold and silver had great returns in 2024. And one of the things that I did a video on years ago is there's a big time lag between the price rising and more supply coming online. The price rises and it encourages more mining, except taking mines out of mothballs that were not productive at $15 and then with it at 25 or 30 bucks an ounce or whatever, it can take years. And so there's like a 4 to 6 year lag before that catches up. So we've only had the price starting to rise immediately. So this deficit will probably keep on going. So go ahead with what you were saying.
Yeah, basically, like the main story here was supply and demand is that demand for silver is outstripping supply, and it has been for the last 4 years, and it's probably going to continue in 2025. And when demand for anything is higher than the supply, the price has to go up. I mean, it's basic supply and demand. So you can see here this total demand line, this dotted line at the top of this chart, is actually higher than the total supply line. And by the way, this chart goes back to 2015 up to 2024 as a forecast, right? At the time they made this, 2024 was a forecast. Of course, that year is behind us now.
And right. That was a forecast at the previous prices and everything. So this is supply and demand, has nothing to do with price, but the forecast, we probably ended up using more silver up. And yeah, go ahead. I'm sorry.
Yeah, well, that's sort of the main story. I don't know if you want to dive into any of these individual categories, Mike, like electronics or net physical investment, jewelry, anything like that. Otherwise, we can move on to the next chart.
Net physical investment may be larger than what they were forecasting because of the big price rise that we had in 2024. And then when you go out to whenever the next crisis is, back in the bull market of the 70s, that final blow off top, the spectacular gains that silver had was when there was monetary demand. And that net physical investment, which was actually minus 31% from the beginning of this chart to the end of it, it's minus. That thing is going to go huge. That will be by far the largest category. It'll just suddenly jump up, and the silver deficit, the supply-demand imbalance, will just explode. But the price goes up high enough to where there is a gold and silver rush, and everybody goes out to try and establish mines. But it can take 10 years to get a mine open and producing. So even with mines that are in current production, ramping up production can take 3 or 4 years. Mines that are mothballed, it depends on whether or not that mine got high graded, where when the price is low, in order to make it economically feasible to keep the mine open, they start mining the most dense veins of silver, making the silver that's still in the ground around that really dense vein not very economically feasible to mine until the prices go astronomical. And so the odds of these mothballed mines getting reopened and back into production before we have a blow off top, before we have a giant crisis and huge net physical demand, because it's monetary demand. People are worried about the dollar. They're seeing silver making spectacular gains. The fear of missing out causes more people to jump on board. The price explodes. But even with the exploding price, the supply does not react to it instantly. The video that I did it showed at least a 4-year lag, except that 4-year lag is becoming longer as we go out in time, permitting and everything. So the 4-year lag is something that seemed to apply to the 70s, 80s, 90s, and then it was getting longer in the early 2000s. But as we go forward with regulation, permitting, and everything else, it's going to be a while before we see the silver supply catch up with the demand.
Yeah, I believe it. Let's take a look at a related chart here. This is the silver market balance. Sorry?
So it's the same chart in a different format, right?
Yeah, it has some of the same pieces. Yes, exactly. Yeah. So the bar chart component of this is either a surplus or a deficit, basically supply minus demand. And when demand is large, we have a deficit. There's these 4 scary red bars that are very significantly negative. 2021, 2022, 2023, 2024, and 2025 could look similar. And the white line here in the foreground is the price of silver, hovering around $30 an ounce.
Around what?
Around $30 an ounce.
Yeah, the numbers are a little small on my end, but $30 is where it ends up at. Okay.
Yeah, 30 or 29 is where they have their latest price there. So yeah, so basically, again, looking at supply and demand, it's the same point. If we are going to have a massive deficit, eventually we're going to run out of stockpiles of silver above ground. So price is going to have to move. And to your point, Mike, there could be a 4 or more year lag before those mines produce and build up the supply again.
And when you referred to the stockpiles, the strategic silver stockpile is pretty much gone. Governments around the world don't have enormous stockpiles of silver in their treasuries anymore like they used to. That's all been sold into the market. It's gone. It's been used. And it's in landfills now or in investment bars. And so the stockpiles that are left are investment stockpiles. So as we have this deficit, it means that industry is going to have to buy that silver from investors.
Yep, exactly. And investors are going to demand a higher and higher price in order to part with their silver.
Exactly.
So the big question now is, how high can it go, right? And that's sort of like the second half of our video for today. And there was one tweet that we saw recently asking $3,730 per ounce silver, ? That sounds obviously quite outlandish, but the way that this person arrives at it is using the Dow-silver ratio and a complete reversion to past the mean, basically to the bottom end. And the scenario is stocks crash, gold rises, silver skyrockets, the Dow-silver ratio collapses. So if the Dow, for example, fell by 50%, then the silver price would be any of these three numbers depending on how the Dow-silver ratio reverts. So a modest 60 to 1 would be $373 silver. 19 to 1 would be almost $1,200 silver. And if it reverts all the way as far as this logarithmic trend could go, and it has never gone, but it could hit that trend line for a third time, that would be a 6 to 1 ratio, which would be, $3,700 silver.
Well, yeah, 19 to 1, though, is where it already has been back in 1980. And so $1,180 silver is quite amazing, except he's assuming that the Dow only falls by 50%. And it is possible that we could see a crash far greater than that.
Yeah, absolutely. So, of course, the Dow could come down nominally. It's also possible that we have a melt up. If we have some kind of hyperinflation scenario, the nominal price of everything could go up. The Dow could go up. It could even double in points. But then, the way ratios work, that means silver, gold, everything else would go up twice as well. So you could double all these numbers. But you'd also have to double the price of your groceries, double the price of gas, double the price of everything. So that's why these ratios are so important, because it takes out that nominal component based on, the currency printer.
Yeah, you and I talked a bit about this before you decided to put together this particular video. And my comment is, it isn't the dollar price that means anything. So this gives you nice clickbait. It's very charming and alluring, $3,730 an ounce silver. But the point isn't the price, because we don't know what's going to happen with the dollar. We don't know what's going to happen. He's assuming a 50% fall in the Dow. Years ago, I came up with something called wealth cycles. And basically, this is sort of wealth cycles. If you sell an ounce of silver today, if you sell a share of the Dow today, which you can do with the derivatives, basically, and then buy an ounce of silver with that share, you're going to get so many more times purchasing power back, being invested in. It's being invested in whatever sector the public is currently ignoring, but is going to rush to in the future. And when they do, there's this enormous wealth transfer. And whatever if they're abandoning ship on stocks, the Dow, the S&P, you sell a share today and then buy silver with the proceeds. And then when silver's nearing its peak, you get rid of your silver, you go back into stocks, and you get many, many more times your investment. And I was at 6 to 1, I think it's somewhere around that 200 times gain in true wealth. Nobody can catch the exact tops or bottoms, though. So nobody should expect that. But still, if it just goes to 19 to 1, which I absolutely think it would, I don't know, what's 1,400 divided by 19? I don't know. But
75-ish.
Okay. 75 times gains in true wealth, So that is huge. And typically, when the stock market crashes and it's down near a bottom, it pays huge dividend yields. So you're buying cash flow. So selling your stocks now, while stocks are super expensive and have no yield, and going into silver, and I call this wealth cycles. I copyrighted that term, and I started working on it back in 2012, I think. And anyway, so let's move on from here. You've got some charts, I believe, that you made from. So show us what you got.
Yeah, I basically recreated this, starting with, of course, you could just build, the Dow silver ratio by dividing the two data sets, of course. But I decided to start with Dow gold, because that's probably more familiar for a lot of people. So we can take a look at that and then morph into the gold silver ratio and then combine the two to get Dow silver. And we can, of course, put numbers on all this. So starting with the Dow gold ratio, this goes back to 1896. And these are annual data points. So the ratio is actually a little bit more volatile than what we see here. This is only capturing, the final one single data point for each year. Whereas, of course, throughout each year, there's higher and lower points.
Yeah, I know some of these peaks by heart. Like the 1929 peak is actually at 18, not 15. So annualized data makes it 15. It's the average for the whole year, but it was 18. Then the next one, it's pretty close. It was 28. So this is like 27 or something on there. And then the final one is 45, not 40 or 39 point something. So it's way up at the top there. And then the bottoms, 1932 was at 2. And in January 1980, it hit 1. There was a day where the price of gold and the points on the Dow were the same. They were both 873 in January of 1980.
Yeah, that's super cool. It's crazy to think that. I mean, imagine now the price of gold being the same as the points of the Dow, 40,000, right? Imagine $40,000 an ounce gold, like the spending power. But that's what it was in 1980.
If the scenario of the 70s played out, basically gold, the stock market went sideways from 1966, where that peak looks like about 1964 or something. Maybe it's 66. But from the Dow bumped its head on 1,000 points in 1966, and it couldn't significantly break through it until 1982. This is all gold moving, not the Dow. And so it's the price of gold soaring. If that same scenario happened, it would require $40,000 gold then, right?
Yeah, if the Dow didn't move, exactly.
Right.
Yep.
Now, take silver at the gold silver ratio of currently right around 90, and then take that to 16. And you would have some explosive percentage gains measured in dollars. Except now, since August 15th, 1971, we no longer have one of these factors fixed. They're both moving. The price of gold and the Dow are both moving targets, which doesn't reduce the volatility, it increases it.
Exactly.
Yeah. So we see even greater percentage gains. So I'm sorry, go ahead. You were saying?
No, I was just saying we see this whipsaw effect where it moves even more and more wildly over time. So as a trader, I guess, and a lot of investors don't think of themselves as traders, but in some sense you are, throughout 40 or 50 or 60 years of investing. That's sort of good for you if you're going to play the wealth cycles, right?
Yeah.
You get bigger swings.
Yeah, that's why they call it swing trading.
Yeah, exactly. So last thing I'll say on this chart is, if you just, of course, I'm the one who made it, so I know what it is. But if you just showed me this chart and you didn't label it, and you just showed me the line, I would say, wow, I can feel the gravity in this chart. When the line goes up, it comes back down. It snaps down. It's like jumping off the surface of the earth and you come back down, right? You go up, you come back down. You go up, you come back down. That's what this chart feels like. And without knowing it's a ratio chart or whatever it is, I would say, wow, it feels like something's trying to move one direction and it comes back. Like there's a natural force that's bringing it back to where it came from. Yeah. And this point right here, which is, 2008, 2009, 2010, it feels like an exception. Like someone was trying to break the laws of physics. Someone was trying to play God and do something to whatever this chart is an example of.
So you're referring to Ben Bernanke and the printing press as playing God.
Exactly, right? It seems like it broke. And even this curvature here is not something we normally see. Normally we see like sort of jagged triangles. We see like sort of it's spikier. And then here it starts to be rounded. It's like a very different motion in the chart. And it's obviously not sustainable. I mean, you can't change the laws of physics. You can only temporarily incentivize people to behave a little bit differently. But I think this has to come back. And, that means big gains for gold relative to the Dow.
Yeah. Well, one thing I'd like to point out too is, it was the mean used to be around 3 or 4. And then we went up to 18 when it went into a bubble in 29. The stock market went into a bubble. And then 1932, it went down to 2. After the bubble in 66, like I said, the stock market was going sideways. It was gold that moved, but it came down to a ratio of 1. Now, it's been much more severely overvalued than it was in the 50s and 60s. And so it's probably going to overshoot even further. There will be an even greater crisis caused by our idiotic debt-based fiat currency system. And that should cause it to overshoot. So I think that it's possible that a ratio of 0.5 is in the cards. That's the realm of possibilities. Now, you said that if the Dow doesn't move, what was it that added up to $40,000 again? Was that, that's the Dow not moving.
Yeah, if the Dow doesn't move, right, gold would have to match it at roughly 40,000. And to go to
a 1-to-1 ratio, but at a 0.5-to-1 ratio, that's $80,000 gold.
Exactly.
But things never work out that way. We've got two things that are moving simultaneously, but they are related to each other. Okay, let's move on to the next one that you've got for us.
Fantastic. Yes, the next ratio is the gold-silver ratio. And again, just like before, these are annual data points. So we're only getting one data point for each year. We're not getting the full volatility here because we know that this ratio is up over 100 at several points lately. But the only one that really shows that is back in the 1940s. And that's actually funny enough. Gold was $35 an ounce. Silver was 35 cents an ounce. So $35.35. It was exactly a 100-to-1 ratio for 2 years here, which was fairly interesting.
Yeah. And in 2020, though, it hit with the COVID crash. That's where it hit 120. It was a little over 120.
Yeah, wild. Yeah. So that's a full other grid line on this chart, significantly higher. So yeah. So anything you want to say about the gold-silver ratio, Mike? We could talk about this for hours, but maybe we can.
Just the this is annualized data, correct?
Yes.
And so you have to imagine that spike down at the bottom in 1980 as going. So if we had a data point for specifically January 20th, I think it was 1980, you would see a much, it would be down at, down there somewhere.
Yeah, a little bit lower than it currently
is.
And
that is silver catching up with gold, by the way. So for anybody looking at this is gold's performance measured in silver, not silver's performance measured in gold. So you have to imagine it upside down if you're invested in silver. And you can see that we have a long way to go from where we are today all the way down to that area down there, meaning that's how many times. If you flipped this upside down, you would see. So you take 90 and divide it by 20 or 15 and whatever that number is how many more ounces of gold an ounce of silver will buy someday in the future.
Yep, exactly. As this swings back down towards the bottom of the graph, that means silver is going to outperform gold by a factor of 4 or 5, possibly more.
Yeah. And the supply-demand deficit is something that's helping to guarantee that. If you take the supply-demand deficit and then you multiply that with monetary demand, some sort of crisis causing people to rush to safe haven investments. And what you end up with is fireworks.
Yep, exactly. So now we put those two charts together and we get Dow-silver. And this is what we looked at in the original tweet or the original X post. But this is linear. So it's the same types of scales that we just looked at in the other two charts I made. And yeah, I mean, you can see that we're up here at an elevated level. So the Dow is overvalued compared to silver. And when this comes back down towards the bottom of the chart, that's silver outperforming the Dow. And it could be by a factor of a lot, 100, 200, I mean, a lot.
Yeah. Right. So, which was the point. If you sell some shares in the stock market today and go into silver, someday you're going to be able to buy many, many, many times those shares back. And this is a gain in true wealth. It's not a gain in numerical wealth measured in a number of dollars. The number of dollars, the dollar lies to you. And yeah.
Yeah, exactly. So we can look at this exact same chart in a logarithmic fashion. It looks like this, and it basically tells the same story. But what I want to do is
just
add,
for the audience, logarithmic shows you constant percentage gains instead of numerical gains. So from 1 to 10 is a factor of 10, from 10 to 100 is a factor of 10, and from 100 to 1,000 is a factor of 10. So it shows you the potential gain in percentage terms, which is what we are interested in, because in dollar terms, who knows what the purchasing power is going to be.
Exactly. So yeah, so same constant factor instead of constant, what would you call that when you add the same amount? So instead of adding the same amount, we multiply by the same amount for each grid line. So yes.
Okay.
And to make it look more like that other post, we can add some trend lines here, support and resistance. And the current Dow-silver ratio is about 1,430. And for that to revert to the long-term trend line of about 10 to 1, right? About 10 to 1, depending where it hits this line. If it's further into the future, it would be even lower than that, possibly like 6 to 1, like we saw on that tweet.
Yeah.
It would revert again by a factor of 100 or 200, depending what number it hits. But that's massive,
Right.
Staggering. It's so hard to wrap your head around getting 100 times the value.
Yes.
Yeah. Okay. So anything else here, Mike, before I move on?
No, it's just that's what you, when somebody invests in something and they're only measuring their investment in dollars, they don't actually know what the performance has been. It has to be gains in purchasing power. If you are invested in one asset class for a very long time and that asset class goes up and down and up and down and up and down, for instance, in real estate, if you own one apartment building, or you own, if you own a home, the home goes up and you go, oh, my home went up in value. No, it didn't, because if you sold it, you could only buy the same home back again for the same price. If you want to be able to sell it, be invested in something else, sell that, and then buy 10, 20, 50, 100 of those of your old house back, the price doesn't matter. It's the value. So
exactly. Yes, exactly. So the final thing I want to look at is actually a different version of what you just said, Mike, and it's something that you put in your book. It's basically the price of silver sort of measured in all these other assets, or as if it would have kept up from its January of 1980 peak. So do you want to explain a little bit more about what this is?
Well, all I did was I took the performance of all of these different asset classes here, bonds, CPI, real estate, GDP, M2, currency in circulation, MZM, which is no longer published, and the stock market. And I just looked at the percentage growth from 1980 through to the time that the book was being published, and you've updated this now to today. And then I averaged it, and it was, if silver had done the same thing, you were talking about $866 silver. If silver had grown at the rate of the Wilshire 500 stock market index, it would be $2,654 an ounce. But even CPI adjusted, which I call the CP lie, I coined that term in my first book, The CP Lie. $213 an ounce silver. I've been saying for a long time that triple-digit silver is in the cards. All it takes is some sort of crisis and for people to be rushing back to it as a safe haven. And we will be seeing triple digit silver. I believe that this is an absolute. And so you take all of these things, you add them all together, and you've got 8 different items here, divide them by 8, and that's the price you get is 866 if history repeated for the implied price of silver. If silver had kept up with the growth of all these other things. So do you want to explain the rest here?
Yeah, exactly. So I thought, well, what if silver kept up with gold? So I basically just added gold to this chart at the bottom here and said, okay, gold was 873 or peaked at 873 in January of 1980. Right now it's trading about 2,600, depending, what day you're looking at. And that's a gain of about almost exactly 3 times the price in, 44 years. And if silver maintained that same gain, roughly 3 times the price, 3 times 52 is 156.
Right.
So if silver had moved at the same rate as gold for the last 45 years, we would be looking at $156 an ounce silver today.
Right.
And by the way,
we need to explain here that if silver, it sounds like silver is a lagging and not doing well when we say stuff like that, but it's actually the opposite. It's just saying that it is incredibly undervalued and has huge potential in front of it. And the reason it didn't keep up with gold is because, yes, it was in a bubble in 1980, and it fell more than gold from January of 1980. And it has become so undervalued. And then when you add that supply deficit to these factors, and then the potential of some sort of crisis and a rush to safe haven assets, that's when you realize how incredibly undervalued silver is.
Yes, exactly. It's the biggest sale there is. Silver, it's like the biggest discounts possible. And that's like that gravity we were talking about. Everything has to go back and forth, return to where it came from. So yeah, that's all I got, Mike. Otherwise, I would just remind people that this came from your book, chapter 9, I believe, and your book makes a great gift.
Yes. Well, thank you very much. Yeah, people should go to GGSR21, download the free chapters, and we don't even ask for your email address. It's all a gift, basically. So I want to thank you, Alan, and we'll see everybody next time. Thanks for watching.